Often you'll hear people refer to your credit rating as a reason credit is denied. That's not the only reason. You could have excellent credit, but still be denied because you're carrying too much debt. Lenders look at something called debt-to-income ratio, which measures money in versus money out. In other words, lenders look at how much you owe compared to how much you make each month. They look at three segments: consumer debt to income, which includes credit cards, student loans, anything that isn't housing related, then housing debt to income, which is rent, mortgage, condo fees, etc., and then the total debt and housing payment. By calculating those three segments, they determine whether you're carrying too much debt. One way to stay financially healthy is to calculate and monitor your debt-to-income ratios. Even if you're not a math guru, the ratio is relatively easy to calculate. First, let's calculate the consumer debt-to-income ratio. As a rule of thumb, it's best to keep the ratio below 20% of your after-tax pay for it to be within acceptable range. The math is only 2 steps. Add your total monthly debt payments, credit cards, student loans, etc., excluding your mortgage or rent. Then divide that by your total monthly net income. That's your income after taxes. It may also be called your take-home pay. Let's look at an example. The household debt payments total $300 per month, and total after-tax pay is $1,900 a month. When you divide 300 by 1,900, it comes to 0.1801, or 18%. In this example, the debt-to-income ratio is 18%. That would be considered acceptable because it's below 20%. Housing debt to income is best kept below 28% of your gross pay. That is your pay before deductions. The math is similar to the prior example. Take your total housing payment, which is your rent, mortgage, condo fees, etc., then divide that by your total monthly gross income, again before deductions. In this example, housing cost equals $720 a month, and your total gross income is $2,900 a month. When you divide those numbers, it comes to 0.2482, which we round up to 25%. Since this is below 28%, it would be considered within an acceptable range by lenders. The last segment looks at total debt to income. Between consumer and housing, the total debt to income is best kept below 36% of the gross pay. Same process. Add your total monthly debt payments and your housing payments together. Then divide that number by your total monthly gross income. The total debt payments equal $1,020 per month, and the total gross income is $2,900 a month. When you divide those, the ratio is 0.3517, or 35%. This exercise simply looks at how you're managing debt. Even if you're within acceptable range across the board, it doesn't mean that you should add to the debt. Remember, it's best to keep debt as low as possible. If you become overextended, it takes personal effort and discipline to get your situation under control. Here are a few tips to help you get back on track. First, stop the bleeding. To get out of debt, you've got to stop adding to it. Go on a cash-only diet, and don't let a single dollar go to penalties or fees due to missed or late payments. Build a safety net. Stuff happens, and if you don't have cash in the bank to handle it when it does, you'll end up going deeper in debt to pay for it. To avoid this, create an emergency fund of $1,000 as soon as possible. It may take a while, but it'll be worth it. Confront your debt. Know what you owe. Know how you got in debt in the first place, and figure out how to minimize your cost. Ask your lenders to lower your rates or consider a consolidation loan or balance transfer. Just be careful with this one. Know your cash flow. Understand what comes in, what goes out, and how you can free up money to put towards your debt. Pay it down. Pay the minimums on your debts except for the one on which you'll pay an extra payment each month. To save on interest costs, attach the highest rate debts first. To get a bigger emotional boost, attack the smallest balance first. The key is to have a plan and work it. Payday loans may look like lifesavers, but if you can, you should avoid them. They're presented as short-term solutions to temporary cash flow problems, but in reality, they are high-interest, high-fee loans that can quickly create long-term debt. They often carry high interest rates, unaffordable repayment terms, and coercive collection tactics. Penalties for extending loan repayment can be severe. There are alternatives to payday loans. Check with your bank, see if they have loans with better interest rates. Consider overdraft protection for your bank account. Seek consumer credit counseling. These recommendations may not work for everyone. If you don't have a bank account, this may be the time to establish one and set yourself up for future financial success.